Thank you for your time today. I'll just deal with the elephant in the room first, which is AMP. I've been at AMP for 35 years, which is virtually all my career outside of university and mowing lawns and doing other things. It's a company that's given me a lot of pride over many, many years, and there is a chart up there which tells you why. On the side of the building it says Amicus Certus, and the full Latin is Amicus Certus in reinserta, which means a sure friend, I'm going to tangle that up, a sure friend in uncertain times. So that gave me this impression that AMP had a noble purpose. And that sort of inspired me for many, many years. It explains why I've been at AMP 35 years. The events of last year shocked me incredibly. I found them very depressing, upsetting. How could this possibly happen? But I guess it just goes to show that you can always have these things go off the rails. I reckon the bulk of the people who have worked at AMP, who still work at AMP, come to work to do the very best they can for their clients and customers. But sometimes a few people will get things wrong, do the wrong thing, and end up with the sort of mistakes and the wrongdoing that showed up at the Royal Commission there. So the trick, I reckon, is to get back to being a sure friend in uncertain times for all our clients and customers. So I thought I'd just deal with that up front. Happy to take any questions on that if you want to later, but it does seem a bit sad that after 35 years, the most depressing year of my career was last year. So that's just the way things turned out, unfortunately. I want to deal with some of this. I reckon when you're starting off investing, it's very, very important. I must admit, I love that video just there, and I was trying to work out where it is. I think it's somewhere near Brooklyn, if I'm guessing right, which isn't too far away from where I am, sort of. But to sort of have that, a lifestyle you want, you've got to decide how to invest, what your strategy is going to be. Do you want to put a lot of effort in? Do you want to put a little effort in? And I think it's nice to start off with 9 high-level things, which I've put down here. The first one is make the most of compound interest. Any of you have seen Dr. Don Stammer over the years? He was a well-known economist, financial commentator, still writes for The Australian, going back to the 1970s, I think. And he's always stressing the importance of compound interest and don't get thrown off by the cycle. Yeah, and of course I had one of those up on that little thing up there about cufflinks, which has now become part of Morningstar. But that I think is very important. If I look back to 1900 and put $1 down as an investment in 1900, these are actual numbers, and if I put it in Australian cash, today it would be worth $240. If I put it in Australian government bonds, both of those assets are safe. Australian government bonds would be worth $950. If I put it in shares, because of the dividends getting reinvested along the way, and it applies to the other assets as well, because of that compounding, that would have grown to $593,169. Now, you might think, how can that possibly be? It's just the magic of compounding. A 10% return this year, 10% the next year, maybe a minus 20 in there at some point. But over time, it goes up and the returns build on themselves. Now, you do get those setbacks, like in the 1930s, like soon after I started my career, which is 87, just there, like when the Brady Bunch was canned in 1974, and horrible things happen, like the GFC. And you don't want that. But if you have a big enough balance, it makes sense to try and take a long-term view and get the most of compounding. Now, of course, if you're about to retire and that happens, it's a different story. So you've got to adopt a different approach when you are in retirement. And that depends on the size of your balance and your risk tolerance, and also your income and spending needs. But I think that the first rule is make the most revenue you can of compound interest. Don't get blown off by the cycles. Try and invest for the long term. Always diversify. I love dividends. I rave on about how great dividends are. They're like a bird in the hand is worth 2 in the bush. I think it's great that we have those dividends in Australia and companies pay decent dividends here. But I work for a company that recently slashed its dividend. And you say, well, how, Shane, can you be talking about this? And my response to that is, well, Francisco Di Ferrari is here a bit later. You can ask him regarding the dividend. But I think the key point is to have a well-diversified portfolio. You never know. Someone will cut their dividend, but if you have a well-diversified portfolio, that will protect you. Turn down the noise, very, very important. My mother recently gave me a pile of old papers she'd kept over many, many years. Of course, that goes back to 1941. And that is a big story. That is trivia. Last week we were told yet again, 35 billion wiped off the share market. Shock horror. How did this possibly happen? But put it in context, that's about a 2% fall. It's a non-event in the great scheme of things. That is a big event. Increasingly, we're getting distracted by a lot of trivia. So turn down the noise, Stay focused on your investing. Those things down the bottom, they're pretty obvious. Always try and buy low. When the market's coming down, look for the value. When they're way up here after a huge gain, risk of correction, that sort of thing, that's the time you should be thinking of winding back a little bit if you are thinking of winding back. Beware the crowded extremes. Who here thought of piling into Bitcoin end of 2017? Now, of course, no one will put their hand up, but I reckon some of you did. Even my dog was talking about Bitcoin. Well, the price it peaked at back then was 19,500. When the last I looked, I've lost interest now, it was about 8,000, 10,000 or something like that. So when everyone is talking about something, it's often time to get cautious on it. Focus on investments you understand and seek advice. Now, seeking advice could mean getting a financial advisor. It could mean just getting a quality research source, like that lady up around Brooklyn was doing. And I like the fact that she sort of limited it to say, well, I just read this one. Because if you go to all of them, you'll get yourself very distracted. And I think it's right to get a consistent sort of approach. You might have 2 or 3, but try and get consistency there. Don't get yourself blown off by every commentator who just pops into your inbox and distracts you. So anyway, moving on to how we see markets. This one I think is very important. I want to just put this up here. Don Stammerer said, you've got to try and leave with your kids a sense of optimism. If you don't have a sense of optimism, then there's no point owning an investment property because you're not going to be optimistic that people are going to pay their rents. There's no point putting money in the bank because you're not going to be optimistic the bank's going to be around. There's no point buying shares, little companies, because you'll have no optimism they'll ever grow to be big companies paying decent dividends. So you've got to have a sense of optimism. I love that little quote there, pessimism, anything that can go wrong and doesn't go wrong. A lot of people said house prices will crash. And then when it doesn't happen, they just come back and say, oh, it's just waiting for a much worse time to go wrong. We've been waiting for 15 years for that crash to occur. So let's move on to how I see the outlook. A lot of details up there. 2 big themes driving things. On the negative side, we've got high debt levels globally. We've got a rise in inequality for a whole bunch of reasons. That's led to some degree to the rise of what I would call populism, a backlash against the economic rationalist policies of the 80s and 90s, globalisation, deregulation, privatisation, and that is leading to things like trade wars, re-regulation, and a whole bunch of things which aren't as market-friendly as we saw, say, going into the 1980s. So that's creating a bit of volatility, and you can see that recently around trade, the trade war. On the positive side, though, and this is why share markets aren't crashing, you've got a bunch of positives. You've got very low inflation. You've got technological innovation. Getting Morningstar on a website in your inbox or wherever it is, was impossible 15, 20 years ago. The world has changed dramatically. Very low inflation, very low interest rates. When interest rates go down, it makes shares and other assets more attractive in a relative sense. And these positives and negatives are sort of vying with each other at different points in time. Last year it seemed the negatives won out, this year it seems the positives are on top. But in a big picture sense, global growth has slowed, but I don't think it's about to collapse. And I'll come on to that in a moment. Yes, the risk of recession has gone up because of the trade wars, but I think ultimately it gets avoided. That's probably a key takeaway from what I will say today. Inflation is below target in most countries, so central banks, including the Reserve Bank, are easing. And I'll talk a little bit about the Reserve Bank. Ultimately, I see them cutting to 0.25%. Some of you may not be too happy with that news because it means your bank deposit rates, if you're relying on interest in bank deposits, will get lower and lower and lower. Probably more downside in the Aussie dollar. Not too happy with that one either if you want to go on an overseas holiday, but that's the point. Back in 2011, going to the US was very cheap. $1 bought $1.10 US. Today, buys 67 cents. Very expensive. So you have your holiday in Australia. So that's the whole point of the Aussie dollar going down. Very low returns from bank deposits and bonds. Share markets, vulnerable to a short-term pullback, but should do okay over the next 6 to 12 months. But you're still going to have that ongoing battle between those positives and negatives that I referred to, and that's going to cause bouts of volatility as we go through time. Now, if I look at the economic cycle here, I've shown GDP growth globally in red, and I've shown a measure of business confidence, what they call PMIs to get technical, in blue. And you can see that's the GFC, big collapse. Lately we've been doing up, down, up, down. And every time we have the downs, in 2012, 2015, 16, and more recently everyone said the sky's falling, we're all ruined. And then, of course, central banks cut interest rates and we start to pick up again. And I reckon you're going to see the same thing this time around. I don't think we're going into another rerun of the GFC. Now, if I look at the US, unfortunately, I've got too many slides here, as always, trying to finalise my slides last week to send them off to my friends at Morningstar. I end up with too many and then realise I've got to cut back to fit in the time slot. Doesn't matter. I'll happy to take questions, or if you want the charts, you can get them later and look at them, and that'll help you sleep at night because it'll give you insomnia looking at them. But, well, hopefully not. But anyway, when I look at the US, there's been a lot of worries about a US recession. People say, well, the yield curve has inverted. I reckon 12 months ago, no one knew what a yield curve inversion was, but it's where long-term interest rates fall below short-term interest rates. Out of interest, that yield curve inversion has miraculously disappeared in the last few days. At least one of them has miraculously disappeared as bond yields have gone back up. But other indicators, well, firstly, I'd say on the yield curve, it's not a perfect predictor. It sometimes gets it wrong, as all indicators do. It's only inverted for a short period of time, so that may be one of those occasions where it gets it wrong. And other indicators are not pointing to a recession. I think the simple way to put this is like this. When you have a long and strong economic recovery, excesses build up. You get wage growth, you get very low unemployment causing wages growth, you get inflation taking off, the central bank jams on the brakes, meantime debt levels have gone to very high levels, and we've got a spending boom because everyone's feeling so happy. Well, lately we haven't seen that. We haven't seen the excesses that normally build up prior to recession. So I think ultimately we end up avoiding recession. Now, of course, the big debate is about trade and the tariff war. I won't go into the precise details about how many tariffs have been put on by whom. It gets very confusing. But one thing I would point out is that today is different to 18 months ago. Donald Trump is getting close to having to get re-elected again. In a year's time, he'll be virtually there, November the 6th or whatever it is, next year, November the 7th or something. And he wants to get re-elected. Only problem is that the tariff war has gotten worse. China hasn't quite given in, and that's affected confidence in the US. And the problem why businesses are feeling a lack of confidence is because the parts that feed into their business come from all around the world. And so they're worried about where to invest. Also got a Dreamliner. The bits that feed into a Dreamliner come from all over the place, including Australia. So if there's trade barriers going up, that makes them lose their confidence. Now, I reckon at some point, fairly soon, he may have already got to that point, he's going to say, well, the most important thing for me is to get re-elected. I can't allow this uncertainty cause a recession. Therefore, I've got to come to some sort of at least truce, a lasting truce with the Chinese. And I reckon we're sort of getting there to that point. If you go back through history, US presidents, when they're allowed to have a second term, tend to get re-elected, unless the US economy is seeing rising unemployment and going into recession. Just ask George Bush Sr., Carter, Ford, Hoover, not Coolidge, he did get re-elected, and Taft, if you want to go back through history. They didn't get re-elected because the US economy went into recession prior to an election. So that's very important, and that's why I think Trump is starting to sound a bit more conciliatory, as we saw on the weekend. Now, a bit of good news there. If you don't like Trump, the Mexicans have said they'll build the wall after all, putting Trump in there. What about Europe? Yeah, it's a bit of a sideshow. I'm not going to spend too much time on that. I'll just jump onto this guy. Sounds like we've got a bunch of comedic leaders out there. You know, they're either saying crazy things or they're saying funny things, and this guy's no exception to that. I'm not too worried about this. If I was a UK citizen, I'd be very worried about it. If I had my money in the UK, it would be a source of consternation. But don't forget, the UK is a quite small portion of the world economy these days. Europe is far more important, and on that front, the rest of the Europeans want to stay in the euro. Even the Italians, nearly 70% of Italians like the euro. They're not going to leave. So the impact of a hard Brexit, where they come out with no free trade deal, would be a lot worse for the UK, because 46% of UK exports go to the European Union, but only 6% of European exports go to the UK. So I think if they do have a hard Brexit, looking unlikely now, but if they do, I don't think it would be catastrophic for the world economy. And just on that point about the world economy, this is what you should focus on. The US, China, this is their relative size. Rest of Europe, the UK is that little bit there. It's only a little bit bigger than Australia. So just put it in context, just a bit bigger than Australia. So to me, it's US, China, the Eurozone countries, Germany, Italy, France, Spain combined, and then Japan. They're the big ones. And of course Australia, because that's where you live. What about China? It's slowing down. You can't grow at 10, 12% forever. You know, the wealthier you get, the harder it is to put machines in front of people and make them more productive. And so China is slowing down. It's been obviously hit by the confidence issues around trade, but I don't think it's enough to knock them into recession. You see determination in China to keep growing, and I think that's going to remain the case. The other thing to note about China is that the services sector is now more than 50% of their economy. So like Australia, they are transitioning from manufacturing to services. That's the way that economy is going. Increasingly, the opportunities for Australian companies will be on the services front going into China, not so much the resources front, although that has a fair way to go. Now, one of the things you've noticed about this, so I painted this picture that says, there's a few risks out there. It's going to cause volatility, but probably not a recession. But in the meantime, you've got this phenomenon going on. America has the lowest unemployment rate since 1969. And 1969 was the year my favourite TV show, The Brady Bunch, started. It ended in 74, in a bear market in 74. Our share market fell 59% into 1974. The only thing is, very low unemployment. Even if you allow for the underemployed, you still only have, even if you allow for the underemployed, it's still roughly at a record low. So whether it's unemployed or allow for the underemployed, very low unemployment in the US economy, and yet wages growth is only around 3%. So it goes to this point about inflation being very, very low, very different to the 1970s and 1980s. So obviously, a lot of us are concerned about artificial intelligence, and that's something keeping wages growth down, and I worry about it too. But I got a sense of relief recently when I saw this survey which came out in the US. It was actually in the Wall Street Journal, so I should be able to refer to it here. Americans were asked, would you consider having sex with a robot? 65% said no. So there's some things that robots can't do. But interestingly, they were then asked, is it cheating? And males were more inclined to see that it's not cheating. Females more certain that it is cheating. So if you got a male partner, then I'd be worried about that male partner of being off with a robot. But anyway, that gave me a little bit of confidence that robots can't do everything. So maybe there's a bit of hope there. But still, very low inflation around the world. That is keeping interest rates down. A lot of people say, what's the central bank's doing it? I don't think it's quite that simple. I think when you allow for technological innovation and caution on the part of investors, that's all pushing interest rates down below the levels that central banks have been setting. Now, how did we get an inverted yield curve? Because the market pushed US interest rates down below the federal funds rate, below the US central bank's rate. So the central banks have really just been playing catch up to market forces here. But it is a world, very low interest rates. That's probably going to continue for a while yet. What about Australia? I got nervous last year, because I saw this cover of the Economist magazine in November. Aussie rules the kangaroo going through the cloud. I recalled what happened to Brazil when they were on the cover 10 years ago. Brazil takes off, Christ the Redeemer taking off. 4 years later, Christ the Redeemer is crashing into the mountains. So I'm kind of worried about what that kangaroo is going to be doing in a few years' time when we're back on the cover. So ever since then, we've been worrying about the Australian economy. If you've noticed that, since November, suddenly all these concerns about the Aussie economy have crept in. A lot of talk about a recession, big slowdown in economic growth, latest growth number 1.4%. That is the slowest since the GFC. So very slow economic growth. So it's GDP, that's the quarterly rates down there. A lot of talk about a recession. If you look at Google a lot and look at financial stuff, you'll often see this ad, Daily Reckonings, recession rating, and they say it's extreme. Now, just bear in mind, they've been saying that for a few years now. I do follow these things. I know they were saying it back in 2014. A lot of people over here saying the same thing, the looming Aussie recession, da-di-da-di-da. I won't go through them all. A lot of talk about recession in Australia. I don't think it's going to happen. I think there are risks there. I've got a list here of 9 reasons why it probably won't happen, and I'll just go through a couple of them. First one is, yes, housing has slowed down. So that's the big drag. Housing construction is slowing, and that's dragging on consumer spending, because if you're finishing less houses, then you don't buy as many furnishings to go in those houses. So that's a constraint on here. But against that, mining investment was collapsing. That's mining investment as a share of the economy was booming. For the last 6 years, it's been collapsing. Lately, it looks like it's starting to pick up again. So the big drag on the economy from falling mining investment looks to be over. Secondly, non-mining investment looks to be relatively stable. Education exports are booming. Tourism is doing pretty well. We've got an infrastructure spending boom. I think I had the graph here somewhere. Maybe I took it out. Doesn't matter. We've got an infrastructure spending boom going on, and the Aussie dollar is very low. So there's a bunch of things that I think will keep us growing, but it's going to be slow, and it's probably not going to be enough to get the unemployment rate down. The other thing that's happened is that we were going through a house price decline, and there was a worry that that would keep going on, dragging on confidence and dragging on consumer spending. Interestingly, recently, auction clearance rates have taken off again in Sydney and Melbourne, and house prices are starting to pick up. So it looks like the risk of a housing collapse is starting to fade to some degree. So, problem is that even though we're not going into recession, growth is still not strong enough. It's still not going to be strong enough to get unemployment down. Underemployment, if you allow for unemployment plus underemployment in Australia, we're running around 14%. In the US, we're running around 6.9%. So they can only get 3% wages growth. What hope have we got when we've got 14% roughly of the workforce either unemployed or underemployed? And we're running subpar economic growth. So this is why the pressure is on the Reserve Bank to lower interest rates. Why is inflation so low? Now, I know a lot of you are thinking, well, I just paid my health insurance the other day and it keeps going up at 5% per annum. My electricity bill's been going up and so on. But there's a bunch of other things out there that we spend money on that have been going down in price. I saw this ad in one of these newspapers my mother sent me. Must be from 1966. Sydney goes gay for LBJ. I guess you wouldn't use that headline these days, but was for a Hanamex slideshow. And you remember back in the 70s, you'd go to your friends and have a slide night, and you'd usually fall asleep or the gadget would blow a bulb or something. Anyway, that thing in 1966 cost $69.50 for the cheapest one and $99.50 for the most expensive. That is a small fortune in 1966. These days, you can just show up. If you want to show off your family photos for your holiday, show up at your friend's house, project the photos onto the screen, the TV screen will be the Apple device, and off you go, all very cheap compared to back then. Here's another example. That's me in my car. That's a Holden. And I bought this thing 2 years ago. It was one of the last ones being made, so that's why I bought it. It was the exact same car that I bought 7 years before in 2010, but the price was exactly the same. And yet it's full of all sorts of gadgetry. Another example of falling prices. So yes, some things are going up, but the bulk of them have been very weak, very, very low inflation. So that's put pressure on the Reserve Bank. You've got a situation, relatively high unemployment, underemployment, economic growth too slow, and inflation too low. So they've had to do things. They cut interest rates. What can they do going forward? There's a bunch of things they can do. Ultimately, I would prefer to see more fiscal stimulus, because I do worry that as you keep cutting interest rates, that's fine if you invest in the share market, but not so good if you're relying on bank deposits. So that can fuel inequality. And it's also not guaranteed that you've got low interest rates or you're doing money printing, that that's actually going to help things. Whereas fiscal stimulus is more likely to have a guaranteed and fairer impact. But as we hear from the Treasurer, as we hear from the government, fiscal stimulus is unlikely anytime soon. They're still more focused on the budget surplus. So it all comes back to the Reserve Bank, which is why ultimately I think they'll probably end up cutting interest rates further. And next year they might have to look into doing quantitative easing. So you'll probably think I need a drink. I don't want lower interest rates anymore. This just shows the optimal number of drinks. That's the number of drinks per day. That's your death rate, high or low. This is very important stuff. You need to think about this. Of course I do. And I worked out 2 is the optimal number. And I got this off some doctor who told me this. And interestingly, you've got a high risk of dying if you're a teetotaler, and your risk of dying goes down. And then eventually, by the time you're drinking 6, your risk of dying is back up again. So you might as well have 6 rather than being a teetotaler. But in any case, I sort of did some digging on this, and I looked at what is the recommended guideline for daily consumption of alcohol. And interestingly, I won't go into the details, it's 2 standard drinks in Australia. So they must have seen the optimal point on my slide there. 2 standard drinks for, where are we? It's moved a little bit. Australia there for females, 2 standard drinks, and males down here somewhere, just there. In America, the recommended guideline for males is 5.5 standard drinks, and for females is over 4 standard drinks. So that explains why they voted for Donald Trump. Trump. Their brain cells had been wiped out or they were drunk on the day or something. Anyway, let's move on to the cycle. The key point about the cycle is this. For the last 6-7 years, we've been debating about, are we late in the cycle? We had this debate about a year ago, it was alluded to. Interest rates rising. Are we late in the cycle? Are we going to get set up for another major bear market because interest rates are going to go up and push markets down? And of course, something always keeps coming along, whether it's the Eurozone crisis, whether it's the slowdown we saw around 2015-16, which was partly China-related, and then more recently. So the pickup through the cycle keeps getting delayed. And consequently, share markets seem to just keep grinding on through time. So, I'll zip over that one. That was global charts. But this is Australia. Think about this. That's the one-year bank term deposit rate. Back around 2009, it was about 8%. Today, 1.3%. This is the average from the major banks, 1.3%. The grossed up dividend yield on Aussie shares is around 5.5%. And it's not that different. It hasn't changed much. So the point about that chart is there's quite a lot of value to be had still in the share market. You've got to be careful here if you're taking your money out of bank deposits and you just want the income flow. You've got to think about what is most important to you. Is it avoidance of any volatility in the market? Then you've probably got to stay in bank deposits. But if you focus more on getting the income, then there is value in the share market. But you do need to have a well-diversified portfolio of income-producing stocks there. You can't just rely on one or two. So that's share markets. That's why I think what happens here, every time we get ourselves knickers in a knot, we get worried about the markets, they come down, and then we sort of start to think to ourselves, you know, I'm only getting 1% in my bank account, I might as well put it back in the share market. It goes back up again. The key in all of this is if we avoid a recession, because history shows if we don't avoid a recession, then it's a different equation. You go back through history, there's been lots of occasions where the Aussie share market came down 20%, global shares came down 20%, and then took off again. But on those occasions where they go down 20% and a year later they're down another 20%, that's invariably when you have a recession. And my point is I think we'll probably avoid a recession. So, other alternatives, again, this shows the 10-year bond yield. There's been a collapse through here. This is 1984 when I started my career. The 10-year bond yield was 14%. Back in those days, you know, the old saying was you'd go to work, have a hunch, buy a bunch, go to lunch. And that was it. You didn't need to work too hard because interest rates, dividend yields were so high. These days, if you put your money in 10-year bonds, you won't get 14% for 10 years, you'll get 1% for 10 years. That's the latest 10-year bond yield. So kind of depressing there. But you can see here the property yield on residential property has come down. It's actually lower than that in parts of Sydney. But commercial property yields haven't come down as much. So I would say that commercial property, this is office, industrial, retail, are worth looking at. Now you've got to be, again, diversified. There are some issues with retail property recently, but if you have a well-diversified portfolio, then I think you should be able to ride through that and you'd be getting a relatively decent yield. Now, the same applies to infrastructure investments. What about the Aussie dollar? I've already said probably goes down lower. That's the gap between the Australian interest rate and the US interest rate. It's getting less and less and less. It's gone negative, and therefore people don't want to park their money in Australia. So the Aussie's gone from $1.10 to 67 cents. And I think probably has a bit more downside, but I don't think we're going all the way back to 48 cents, which was in 2001. So let's put a bit of context around this. I might just run through a joke. I don't usually tell jokes because I forget the tagline or I forget the joke, whatever it is. But anyway, this one was quite a good one. I was at this seminar and someone told this and I thought it was really appropriate. There's this guy walking through a forest, obviously the Northern Hemisphere somewhere. He looks behind him and there's a bear chasing after him. He starts running. The bear eventually knocks him to the ground and the bear is over him about to sort of pounce and grab him. And the guy yells out, "God!" And suddenly the bear freezes, the trees stop rustling as the wind stops, the streams stop flowing and all sorts of things. You don't hear the birds anymore. And God says, "My son, what can I do for you?" And the guy says, "Well, I need some help here." And God says, "Well, what do you want me to do? Do you want me to convert you to be a believer?" And the guy says, "No, but you could convert the bear." And God says, okay, if that's what you want me to do, I'll do that. And Anyway, next thing he knows, the bear kneels down. After a little while, God clearly goes away because the birds start tweeting and the stream starts flowing and the wind comes back. And the bear stays kneeled down and says, "Dear God, thank you for the meal I'm about to devour." So you've got to be careful about what you wish for. And so it often strikes me when all those people out there saying, "I want property prices to crash." I reckon make it more affordable for them, but they're probably going to lose their jobs in the process. So it's not necessarily the case we want property prices to crash. But in any case, just look at the last 5 years, put things in some context, lots of volatility, lots of noise, but the average return from a balanced, diversified fund was something like 7%, and lots of asset classes have had pretty good returns despite all that volatility. So as I said before, very, very important to turn down the noise. Last night I was watching The Bachelorette, and tonight I'll be doing the same thing. You know, I resisted for many, many years, but you've got to find some way to turn your mind off, to keep it fresh. Otherwise, you'll get obsessed with what Donald Trump's tweets are. And the problem with Donald Trump's tweets is that in September, he did 797 tweets. 797. Now, if you look at my Twitter account, I'm a fraction of that. Now, 797 tweets in 1 month is 26.5 in a day. So that's what he's averaging every day. That can be very confusing, very, very noisy. You've got to try and turn that stuff down. Maybe it also tells us something about Donald Trump because his norm was about 200 to 300 and suddenly he's way up here. He's obviously worried about something. So key point about all that is, yes, there's a bunch of negatives out there and that's going to cause volatility. I do worry about rising inequality. I think there is a better way with some fiscal stimulus without necessarily blowing the budget surplus. The trouble is it's taken us so long to get back to the surplus, so that worries me a little bit too. But I think the key is in all of this, in an environment of low interest rates, providing we don't have a recession, then the environment for investment markets is still a reasonable one going forward. So I'll end it there. That's the disclaimer that says, if you thought I was here, you're mistaken. It was all a mirage. No, that really just says I can't provide financial advice, go seek an expert. So I will leave it at that. I think we've got a little bit of time for questions. So, thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.